The majority of technical traders in the foreign exchange market, whether they are beginners or professional, have come across the concept of multi-time frame analysis as part of their market education. As the name suggests, the multi-time frame analysis can be defined as the process of analyzing a same currency pair over a series of time periods in an attempt to determine its direction and entries. As a rule, it follows a top-down approach when trading, allowing traders to gauge the longer-term trend on higher time frame while spotting the trade setups and ideal entries on a smaller time frame chart. Right after choosing the appropriate time frames to analyze, traders can conduct a technical analysis by using multiple time frames to make a trading decision. As a guide to help traders selecting the right time frame to analyze, here is an overview of general time frame for different types of traders and how to combine them. Position and swing traders spend less time monitoring charts, so they can trade with longer time frames. These range anywhere from a 1 hour to the monthly time frame. For example, a swing trader can confirm the direction of the market on a daily time frame, identify the trade setup on a 4-hour time frame, and then zoom into the 1-hour time frame to identify ideal market entry opportunities. Meanwhile, day traders and scalpers usually monitor their chart all day long, so they can trade by using the smaller time frames. These range anywhere from a 1 minute to the 1-hour time frame. For example, a day trader can confirm the direction of the market on 1-hour time frame, identify the trade setups on a 30-minute time frame, and then zoom into the 50 minutes time frame to identify ideal market entry opportunities.